business loans of banks and NBFC. Let us start by telling you about business loans. A business loan is a type of financing that allows a business to borrow money from a lender for the purpose of expanding, starting, or sustaining their business operations. Business loans are typically used to finance major capital expenditures, such as equipment purchases, real estate investments, or to cover operating expenses during periods of slow sales or cash flow. Business loans can be secured or unsecured, and may require collateral, such as real estate, inventory, or accounts receivable. The terms of a business loan can vary widely, including the loan amount, interest rate, repayment period, and the frequency and method of repayments. Lenders typically evaluate a business's creditworthiness, financial history, and future prospects before approving a loan. Let us first compare between bank and NBFC. Firstly, business loans are loans specifically designed for businesses, which can be obtained from banks or other financial institutions. NBFCs, or non-banking financial companies, are financial institutions that provide financial services and products, such as loans, investments, and insurance, but are not traditional banks. Secondly, the main advantage of obtaining a business loan from a bank is that they often offer lower interest rates and longer repayment periods compared to NBFCs. Banks also typically have more stringent lending requirements, including a thorough review of the business's financial statements and credit history, which may make it more difficult for some businesses to qualify. Thirdly, when it comes to obtaining a loan for a business, both banks and NBFCs can be options to consider. Banks typically offer more traditional forms of financing, such as term loans, lines of credit, and equipment financing, while NBFCs may offer more specialized lending solutions tailored to the specific needs of the business. Finally, on the other hand, NBFCs may be more flexible and quicker in processing loan applications, and may be more willing to take on higher-risk borrowers that banks may reject. However, NBFCs often charge higher interest rates and may have shorter repayment periods than banks. Ultimately, the choice between obtaining a business loan from a bank or an NBFC will depend on the specific needs and circumstances of the business. It's important to carefully evaluate the terms and conditions of each lender and choose the option that best meets the business's needs while also being affordable and manageable in terms of repayment. Now let us tell you about the business loan requirements. 1. Business plan. Most lenders will require a detailed business plan that outlines your company's goals, products or services, target market, financial projections, and other key information. 2. Personal and business credit score. Your personal and business credit score will be evaluated by the lender to determine your creditworthiness. 3. Financial statements. Lenders will want to see your company's financial statements, including your balance sheet, income statement, and cash flow statement. 4. Collateral. Depending on the type of loan you are seeking, the lender may require collateral, such as equipment or property, to secure the loan. 5. Industry experience. Lenders may want to see that you have experience in the industry or field that your business operates in. 6. Legal documentation. Lenders may require various legal documents, such as business licenses, articles of incorporation, and tax returns. 7. Business history. Lenders will look at your company's history, including how long you have been in business, your growth trajectory, and any past loan history. It's important to note that every lender will have their own specific requirements, so it's important to research and compare different lenders to find the best fit for your business loan needs. Now let's know what are the KYC documents. KYC stands for Know Your Customer, and it refers to the process of verifying the identity of a customer or client. This is a crucial step in lending, as it helps banks and financial institutions to assess the creditworthiness and risk associated with the borrower. For a business loan, the KYC process may involve the following steps. 1. Identity verification. The lender will request documents such as the company's incorporation certificate, PAN card, GST registration certificate, and other relevant documents to verify the identity of the business. 2. Business registration documents. The lender will also require documents such as the company's registration certificate, memorandum of association, articles of association, and partnership deed to verify the business's legal status. 3. Financial documents. The lender will require financial documents such as bank statements, income tax returns, balance sheets, and profit and loss statements to assess the borrower's creditworthiness and ability to repay the loan. 4. Business plan. The lender may also require a business plan that outlines the purpose of the loan, the expected cash flow, and other relevant details to assess the viability of the business. The exact documents required for the KYC process may vary depending on the lender's policies and the type of loan. It is important to carefully review the lender's requirements and ensure that all necessary documents are submitted to avoid delays in the loan approval process. Now I am telling you, what is CIBIL score? CIBIL score is a 3-digit numerical summary of an individual's creditworthiness, which is computed based on their credit history. CIBIL, which stands for Credit Information Bureau, India, Limited, is a credit information company in India that maintains records of an individual's credit-related activities, such as loans, credit cards, and other credit facilities. The CIBIL score ranges from 300 to 900, with a higher score indicating a better credit history and a greater likelihood of loan approval. Lenders use the CIBIL score as a primary factor to determine an individual's creditworthiness while deciding to approve or reject loan applications. Business loan, current and savings account. A current account and a savings account are both useful for businesses looking to unsecure a loan. A current account is typically used for day-to-day transactions, such as paying bills and receiving payments. This type of account often comes with a debit card, checkbook, and overdraft facility. When applying for a business loan, lenders may look at your current account to assess your cash flow and how you manage your finances. A savings account, on the other hand, is designed for businesses to save money and earn interest on their balances. This type of account can be useful for setting aside funds for future expenses or investments. When applying for a business loan, lenders may also look at your savings account to see if you have reserves that could be used to repay the loan if necessary. How do you calculate AMI? AMI stands for Equated Monthly Installment. It is the fixed amount of money that a borrower pays to a lender on a specified date each month, usually the same date on which the loan was disbursed, until the loan is fully repaid. The AMI amount is calculated based on the principal amount, the interest rate, and the loan tenure. The formula used for calculating AMI is AMI equals PXRX 1 plus R, caret N, 1 plus R, caret N1. Where P is the principal amount, R is the monthly interest rate, calculated as annual interest rate divided by 12, and N is the number of monthly installments. For example, if you take a loan of 1 rupee, 00000 at an interest rate of 10% per annum for a tenure of 5 years, 60 months, the monthly interest rate would be 10%, 12 equals 0.0083. Using the formula, the AMI would be calculated as AMI equals 100,000 by 0.0083x, 1 plus 0.0083, caret 60, 1 plus 0.0083, caret 60 to 1, equals 2,125 rupees and 79 paise. So, the borrower would have to pay 2,125 rupees and 79 paise every month for a period of 60 months to fully repay the loan. Indiana 2023, Interest rate of Indian banks and financial institutions. There are several banks in India that provide business loans to individuals and companies. Some of the major banks that offer business loans in India include Axis Bank, 11.50% per annum. HDFC Bank, 10.75% per annum. ICICI Bank, 18% per annum. Bajaj Finserv, 9.75 to 30% per annum. Tata Capital, 13 to 15% per annum. Aditya Birla Capital, 14 to 21% per annum. Ugrow Capital, 9 to 36% per annum. Lendingkart, 15 to 24% per annum. Poonawalla Finco, 15% per annum. CholamandALam, 15% per annum. Hero Finco, 10.5 to 35% per annum. These are just a few examples. And there are many other banks and financial institutions that offer business loans in India. It's always a good idea to research and compare the terms and conditions of different lenders before applying for a business loan. Thank you for learning from options and ideas.